Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. It is June 3rd. This is my Tuesday live stream. I'm super excited to be with you today because this is when I get to share my expertise, my insights into what's going in the market, share my opinion. Of course, it is my opinion. I'm not offering financial advice in any way, shape, or form, and any questions are welcome. So please ask them in the chat. Let me know where you're watching from. I see we've got a couple of people online that are regulars. We've got Kevin online, Don online. Thanks for saying hello. Let me know who else is watching. Got a really important question from Mike Mueller that I'm going to get to. But before we get into that, I'm going to take a look at the market just in general. I have the Fibonacci chart on the SPX. You can see that here, this kind of rainbow band. We're seeing the close to recent highs on SPX. I see Christina is joining from Naples, Florida. Awesome to have you, Christina. And we've got, SPX, are we going to see these all-time highs again? My thought is yes, we are going to continue to push up. All of this market dumping was caused by the tariffs, which seem to be kind of sorting themselves out for the time being. Let's go through the rest of this list. So SPX today up 0.57%, NQ up 0.79%. Of course, SPX and NQ are highly correlated. We can see we're near the point of control at this area. We've got a little bit more room to the upside before we hit these all-time highs, but the trend is definitely bearish. Now, Russell today, you can see the downward trend line that we had on the Russell, this blue line that I've put here on the chart. You can see that here. Breaking outside of that today, up 1.7%. So this is a very bullish indicator for the Russell in general. And hi Hans, good to see you here. Thank you guys for the likes, I appreciate it. So if you have questions specifically, please let me know. I'm looking for some more upside momentum on Russell. I think there's a ton of small cap stocks that have really good valuations right now, and there's lots of potential breakout. There's lots of potential movement to the upside. Now, does that mean we're not going to have some drawbacks or drawdowns? Doesn't mean that we won't, but definitely the momentum seems to be continuing to the upside. Dow Jones Industrial Average, this is I actually don't play a position on the Dow, but we're in the same sort of position for here. We're seeing bullish momentum overall. VIX dropping. Now this is the volatility index on the SPX, and the VIX is at 1782. I've got this red line on here. This is kind of my the average price, not my average price, the average price over a long period of time. If we go back to years like 2017, you would see, and in 2024, we traded underneath that average price for a very long time. When we're above these, the VIX level of that, around that $18 or 18 mark, this is when selling premium becomes lucrative. So I like to sell premium, and I like to collect the premium from holding short premium in options trading. And when we're below it, then I like to play a little bit more, a little bit longer. So it depends on where you are in your cycle. US oil, I closed my position. I've got $63 right now. I didn't open another one. What I'm going to do is I'm going to wait for a pullback in oil. We're actually rallying a little bit. My ideal entry would be if we were closer to the $60 a barrel mark, and then I will put in a similar position that I held last month, which was a nice win. Gold coming down, but again, this trend to the upside is still pretty massive. Really target up here about 3,600 an ounce. I expect to see that by the end of the year. Still bullish on metals. Silver finally catching up a little bit, moving up from $32 over the last 2 days. We're $34.73 an ounce. Finally got an uptick in silver, but we've been calling that for a while. Apple, we'll just go through some of the big stocks here. Apple trading at 202, down near the low part of its range. AMD having a bit of a recent rally, but under its 200-day moving average. ARK-K, one of the questions came up from Don McDonald. I constantly have a position on ARK-K. I trade covered calls against it. My cost basis is actually pretty high. I started playing this in during COVID. So I have a cost basis up over $100, but you can see that this trend, when we look at the last couple of years, the ARK-K, continues to have kind of a typical move. Now we have to ignore the craziness that was the pandemic, because that is what surged a ton of stocks, and a stock like ARK-K or an ETF like ARK-K moved up quite a bit. I think this is more typical for its performance, where we see these similar kind of ranges. If we were to analyze the chart and look at this area and then to look at this area, that's kind of typical for the movement. The reason I have these bars marked on here is because I am looking to sell premium or sell covered calls against the long positions when it's in the top of the range. That's when I like to do it. So when we're down here in the bottom, I typically don't sell. And as we come up through this range, I will sell and then roll them out for credit. And I target about 1% a week on that. So it's about 50% annualized return on an ETF. It's not as volatile as some other individual products. So it's a nice play overall. Relatively low size. You can get 100 shares for just around $5,800 today. Adobe up 410. Now, for those of you here in my service, you guys know that I was buying Adobe back at the beginning of May. So right here, I was taking a long position, and we've had very, very nice gain on Adobe, still holding that long since last month. And one of the things about being in my paid service, for those of you who aren't, is that I do alert every single trade that I make. So I have trades that I put on, and I have like a little bit of some portfolios that I put on where at the beginning of the month, which just happened yesterday, I'm placing new trades and seeing what the performance is over the month. Now in May, my hand-picked stocks returned 8% return, which far exceeded the return of the S&P 500 over the course of the month. So that's the kind of thing I'm alerting on Patreon in the dividend covered call position, or in the dividend covered call Patreon tier. So if you're interested in that and you're not already a member of the Discord server, you can get to the Discord server, join for free, say hello over there, and then there are paid tiers if you're interested in that kind of thing. So that was Adobe was one of the picks for last month. What else are we looking at here? We've got Roundhill products have had quite a bit of recovery. They're not back at the levels that they were, but these continue to pay these massive dividends. So positions like RDTE, I'm continuing to add to these positions at these levels. Stock trading at 33.74, and then if we look at the dividends that get paid out weekly, this is 26 cents last week, 25 cents the week before, 23 cents. So in the last month, it's paid $1 on a $33 ETF. So pretty awesome little positions. And again, those alerts are available on my Discord servers when I'm actually purchasing those shares, because I do try to snipe these and look for entry positions that are well timed. So I'm not just constantly putting in, but I'm looking for decent entry points. SoFi is one that we talk about quite a bit. Stocks trading at 13.55. For those of you looking for low cost, high reward options trading, this is the type of stock that is easily wheeled. It's quite a small product. $1,300 for 100 shares, about $2,700 for 200 shares, which is enough to start the wheel, and a pretty good range. Very excellent premium in that. So something that I like to look at. Tesla, I feel like we're in an overvalued territory right now, but it's really hard to say. I mean, Tesla's got a bunch of tech, going on into the future. They've got robotics. They've got a ton of data collection. Are we going to see these all-time highs again back up at that 488 level? Time will tell. I am not purchasing or going long Tesla at this point because we're over the 200-day moving average, and you can see this point of control way down here at 255. And if we zoom in on a tighter timeline, obviously that point of control is going to move over. When I talk about point of control, I'm talking about this large candle here and this white line. And this is one of the strategies that I have on here. So you can see the volume range, visible range volume profile, number of rows, and it basically just tells me where the volume is. When I look at this chart, was there a bunch of trading happening up here, or was the bunch of trading happening here? And you can see by volume on this left side that the majority of the trading was actually happening here and not here. This leads me to believe that if we were to see a drawdown in value, if the stock started to move down, it was going to fill this gap relatively quickly because this was lightly traded area, and will zip right back down to these levels, which is why I don't like to go long when we're in this type of position, when the visible range is below the current pricing. So these are just types of things that I'm looking at, and you'll see here that the very, very thinly traded on this gap up. So every time I move in, we're just looking at what the screen is. And obviously if I zoom in just on these couple days, this whole area is going to disappear because there has been no trading in that area over the last couple of days. This was all prior, if that makes sense. Type 1 in the chat if that makes sense to you guys. So Don, we're going to talk about ARK-K. I like ARK-K. I like to play it pretty simply, just with short puts, long covered or with covered calls, long shares. That's kind of how I get about it. Sorry to hear that you're going to get called away on Roku. Roll them forward being greedy. Let's look at Roku. Let's just take a look at where it is. And I don't have it here on the list, but we will type it in and find it here. Roku. So we're looking at the daily chart on Roku. It's come up. We had a high of 105. The rate in the range around this 200-day moving average. And again, I'm constantly kind of looking at, volume spikes here, looking at two different types of things. How much volume was there on particular days? And then how much volume is there across the chart as well? So I kind of look at both of those things. The 200-day moving average, super important. And you can see on the volume weighted MACD, we're kind of at a potential inflection point. So this is where we might turn to the downside. I think when we're around the 200-day moving average, this is a pretty safe place to stay. So if I was looking at a position like this and I wanted to figure out whether or not it made sense, let me just minimize that for a second. And if that makes sense to roll it out, I have to bring up the options chain. So if I bring up the chain and I look at Roku and I look out 20 days out, how much value is there, and how aggressive are we? I didn't see what strike you had, but if you could let me know the expiration and the strike, I'm happy to analyze it, and we can take a look and see how much extrinsic value is there and whether or not we can get some money for rolling that out in time. I'm also going to take a look at Roku over here. And we're just looking at that fair value level on Investing Pro. So we've got a fair value of 80.91. So potential to the upside, trading right now at 72.82. And, here's some bullish things, holds more cash than debt on its balance sheet. And then stock price movements are quite volatile. Analysts do not anticipate the company will be profitable this year. That's never a good thing for me. With this type of stock, I tend to trade fairly neutral. I try to collect premium as the primary for what I'm trading with those types of things. So let me know. And who else? Don, I will circle back with you on Discord on Thursday to catch up and get your thoughts. Yeah, John Lindsay says Roku's been going up since before earnings. I mean, if you look at the market, everything's kind of been going up. When are the earnings here? We're May 1st. We already had earnings, so that was a month ago. We've got next one July 31st, and let's just look at that chart. I actually don't play Roku very often, so May 1st was here. We dropped back down to that 57, and now it's been recovering since. I'm not really surprised by that. This is why I look at multiple different services and looking at that $80 value and saying, if their valuation is up here, where is it likely to play over the course of time? I'll just run through it. I don't know exactly what strike you have, but if I was holding, say, like the 66 covered call position, there's still 60 cents in value, in extrinsic value in this position. And by holding this position from now on the 66 call, making a 1% return over the course of the next 17 days. So if we look at that, with the trade itself, it's an 86% probability of making $63 on max loss of 65.24. The break even is 65.37, which is well below the current price. Now, because the fair market value is higher than this, what I might do is I might consider paying to roll up. Now, what I like to do is I like to pay with credit received. So if I was holding a position like this and I was in the 66, what I would need to do is buy it back. So I would be closing this out and giving up 63 cents of extrinsic value that I may that will decay over the course of time. But what I could do is I could roll out to 45 days. And in this time frame, what I can do is I can actually roll up to the 70 call. Now, this is an aggressive move. It doesn't cost a huge amount of money more though. You know, when I look at these types of things, people are leery of paying to roll up. But what the potential is from 66 to 70, you know, I'm increasing the amount of potential by $400, and this is costing me about $100. I'm paying $100 out of pocket to increase my potential by $400 spread, and so that's a net $300 increase. When I compare that with a calculator, if I was to just bring up a calculator, that position, where's my calculator? When we look at it from a return on capital standpoint, currently the trade is worth $6,600 minus that $63 in extrinsic value. So I've got a trade worth $6,537. Now, if I was to let this go for the next 17 days, I have the chance of increasing and making that $63. So my return on capital, remember this number, the 6537, is going to be 63 divided by 6537. So the return on capital is going to be just under 1% in 17 days. And we divide that by that 17 days and we times this by 365 and we'll get a 20% annualized return. Now, if I instead put $100 more into this, I'm increasing my risk. So remember, 6537 is what I'm currently worth, what it's currently worth. I am adding $100 to that from my pot, from my cash balance. So now I have a net investment of 6637. But what I've done is I've increased the amount of money that I can make because I've raised it to the 70 strike. I've also increased the amount of days, but let's just look at the potential. Let's say the stock stays above $70, and now the return is going to be $363 on 6637. So let's do that math. So it's going to be 363 profit divided by 6637. And so it's 5% return, and we divide that by 45 days and we times that by 365. This is for the annualized return. All of a sudden we're looking at a 44% return on capital. Sometimes it pays to quite a bit, that little bit of increase, the $100 more out of pocket to extend that time frame and get out to a higher strike that has more extrinsic value vastly increases the amount of money that we can make. So of course it does come with added risk. You know, I'm risking $100 more, but the $100 more that I'm risking means that there's much more potential in the trade. So I hope you guys followed that. If you didn't, you can go back and watch this. I do have recorded streams, so hopefully that made sense. But basically doing the math on paying to roll up from a covered call at the 66 strike, paying $100 to roll out and up to the July 18th 70 covered call. And I like to do that math because making an extra 24% annualized return on a position makes way more sense than having all that capital tied up and only making a small return, like 20%. Andrew was asking about NVIDIA. Let's take a look at that. We'll pull it up. Thanks for asking. I appreciate when you guys give me tickers. It makes it more fun for when we get to look at these together. So let's look at the fair market value of NVIDIA. Well, Investing Pro, if you guys don't already have it, I think it's a fantastic service. It is a paid service, but I will put the link here. I've got a little link here. I'll put it in the chat and you guys can check it out. And I get a little kickback if you use my link, if you decide to sign up, but definitely worth it in my opinion. It's completely changed some of the ways that I've traded options because I'm looking at this fair value and saying, well, here's an NVIDIA 128, stock's trading at 140. So potential of 9% downside. So when I go and I look at this chart now, when I pull up NVIDIA, and it changes the way that I think about how I might trade this. So we're seeing that we're near, not at all-time highs, but we're near a recent high. And we can also see that there is a large amount of volume. The largest amount of volume traded was around this 118 mark. And this is where when I'm putting on a position and I'm looking at that 200-day moving average around that 127, I'm looking at the volume where it is around that 120, looking at this potential gap that we have. I might zoom in and just kind of see how this volume profile moves around. But we have a gap here on these fast moves, which means if this comes down, it may come down relatively quickly. I might want to take a position on here, but I might want to target something lower. This is where I might use a diagonal or a butterfly and build it out below the current price. Skip strike butterfly with calls. Skip strike butterfly with calls. John's asking, Andrew, starting a covered call on NVIDIA by picking up shares at 140. I don't love to buy shares when they're above current value. What I might do is sell a put if I was looking at buying shares in NVIDIA, and I would do that around that 130 mark. Because when we do that, if we look at NVIDIA here, let me just look on the chain. We've got 140. It's an up day, so not a fantastic day to sell puts, but we're getting $3 or 2% return or 24% annualized by selling the 130 put. Like, that's not a bad return on capital. 80% probability of profit, max return $300, max loss $12,630. So 300. You guys can do that math. When we're making $3 on $130 100 stock position, then that is more than 2%, and that's in 45 days. So just around the 20% annualized. Being more aggressive than that, the 455, 135 collects 455. Now, if I wanted to really amp this up, one of the things that I can do if I want a bullish position is I can actually use some of that credit that I collect to buy a call spread. I'm still collecting in this trade $200. So I've got more than 1% in 45 days for the short put that I'm collecting. And then I'm buying this call spread. And what that does is it gives me a high probability of profit, 68% probability of profit. Max loss is 13,200. And max return is now $700. So I have the potential of making, if NVIDIA continues to press up, I have the potential of making way more money than just selling the short put by itself. Pull up that calculator again. We'll just look at that math. Like, let's just say that it doesn't go up. It stays above the 135 mark, and it stays in this range between 135 and 140. Well, that return on capital is going to be about $210. So $210, and we're going to use the total value, the max loss, 13,270 is the, or 217 rather, 13,217 is the max loss. So the return on capital, 1.5%, we divide that by 45. You guys see me do this all the time. That's the number of days. We times it by 365. This is going to give me an annualized percentage, 12.8% return if it stays between the range of 130, 135. Now, what happens if it goes up above 145? All of a sudden, this trade at expiration is going to be a whopping $710 return. So 700 divided by that same 13,217, I have no more risk on. And now I'm making a 5% return. We divide that by 45. We times this by 365. If I was to be able to do this trade every single month or every 45 days, and it repeatedly continued to go up, this would make a 43.5% return over time. It's an amazing, amazing return. Let's look at the 1 year chart here and just see. Let's look at the 1 year chart on NVIDIA. Does it show my It's always funny, isn't it? You like look at these things and you're like, where's the, here we go, 1 year, 22% this year. So there's a potential of making close to the same return if the stock trades sideways, and potential of making way more if we were to catch some of these upswings, which is quite nice. John Blake is joining, having intense internet issues today, but happy Tuesday. Sorry to hear that, John. knock on wood, mine's working great today. So well, hopefully you're able to see the stream and hopefully you get it sorted. John Lindsay, let's talk about this. Thoughts on a strategy. I saw an option play called a skip strike butterfly with calls. I don't recognize that. I understand option play. Obviously, I'm familiar with their work. Great guys over there. Skip strike butterfly with calls. Can you give us an example, John? Just type out the whole trade with expiration date, any long stock positions, short calls, long calls, whatever it is. Skip strike butterfly. I'm not familiar. Can't wait to hear about it. Okay, let's get into a question that I got from Mike, who is constantly in our chat. I hope you're here today, Mike. I haven't seen you say hello, but he emailed me yesterday and he said, "Good morning. I have a question for you about long reverse iron condors." Now, there's one thing that is interesting in this because it says, like you, I am playing a long condor, a reverse iron condor, when the overnight VIX has gone up. And I actually play long butterflies. So I buy a butterfly when the VIX has gone down. That has been one of the strategies I've been deploying this year, at least in the earlier part of the year. I haven't done it the last couple of weeks just because it's been summertime. I've been not as frequently at my computer first thing in the morning. But that typically I am buying a long butterfly when the VIX is down. This is relative to the closing of the VIX. So if the VIX at close the previous day was higher than when the VIX opened, let's just look at a chart here so we can see where it is right now. So the VIX, if we look at it right now, is down 0.42 or down 2.29. So on a day like this, if this was the opening bell and the VIX was showing red, this is when I would buy a long butterfly. So we may not be playing exactly the same strategy. He goes on to say the risk to reward trade for this seems pretty solid. Definitely the risk reward on reverse condors and reverse butterflies or long butterflies are very, very good. You know, they're high win rate trade, and especially with the butterflies, they have a very, very narrow point of where you could lose the max profit. So the losses tend to be pretty small and the wins are very, very decent. He goes on to say, on the flip side, I'm playing a short condor when the overnight VIX has gone down. So again, I think this is slightly opposite of what I do, but here are the parameters. Now, he's asking me, he's basically saying whatever happens, he's got a 0 DTE trade to put on in the morning. It's either the VIX is up or the VIX is down, and then he deploys one of the strategies. Now he's showed me this, and I love this kind of setup. This is fantastic. We're using options Omega. This is on SPX. It's back tested from June 1st to June 1st of 2025. The setup is pretty simple. It's a short put for looking to collect $4 with 0 DTE entry, then buying a wing 15 below whatever the strike is. So on a morning like this morning, you know, the SPX, if we were to look at what that chain looks like, let's just take a look at the real chain so we can talk about, let's look at SPX here. So if we look at today, the values are going to be different now because it's so far in the day, but let that load for a second. But basically what he's doing is he's selling a $4 put at the beginning, and then at 15 lower or minus 15, he's buying a put to define the risk. And then he's selling a call for $3 and he's buying a call 15 above it. So let's just look at what that would be if we were to do it right now. It's going to be very tight because we're so close to the end of the day. In fact, let's just go out a full day, and it'll make more sense if we go out a day. So looking for that $4 range. So there's $4, and then we're going to buy a put, which is 15 below the 59.15, which is going to be 5,900. This would be the overnight trade. And on the call side, collecting $3, so selling the 620 or 60.20 and then buying the 60.35. This is going to collect a net credit of around $300. And we can see that the average winner right here, 340 bucks. So what that means is that when we look at this profit profile, the SPX is trading inside of that range. And we have, if there isn't a massive move and it stays above 59.15 and below 60.20, then this gets held to expiration and it expires to cash. Now the problem with this is that when it loses, we lose about $1,240. And we're going to look at that on the screen grab, so we can see the max loser was $1,270. And this is based on the fact that we're targeting a $7 entry, and then we know that the $7 entry, the $4 collected, the $3 collected from selling the short put and the short call, some of that money gets given back, and we know the credit is going to be around $340. So when we lose, the average loser is less than the max, which makes sense. And why does that make sense? It's because this trade has a 77% probability of profit. It means that it's going to make some profit 77% of the time. And occasionally it's going to land out in these wings. And sometimes that means that we're going to be at a max loss of 1270. Sometimes we're going to have a lesser loss. It's going to be somewhere on the slope. I know the slope looks rather vertical right now, but maybe there's a trade that only loses $250 instead of $1,250. Well, the average between those is going to be around $750. Average loser, $875. So when we compare this, when we look, max winner was 545. This is when volatility would have been really high. Average winner is around 340. Average losers around 875. This is like a 1 to 3 risk reward ratio. So what we're ending with when we have a high win rate, so 77% win rate, which is exactly what we're showing here, 77% win rate. If we play enough iterations of something like this, when we get an average per trade, we're going to get $61. That means that over this course of time from June 1st to June 1st, over 3 years, $50,000 worth of capital doing one of these trades per day is going to result in an ending capital of $76,000. This is a decent trade. I like this sort of setup. I know you're asking for, like, how do we do better? Well, in the world of options trading, I think that when we have a positive expectancy, we have a reasonable ratio of average winners to losers, means that we're not likely going to get into a massive drawdown from like a losing streak standpoint. We may get some small streaks here and there, but it's going to be a mix. And 77% of the time, we're going to make money. And the losers are, a little bit bigger, but the expectancy is positive. And that's what we're looking for, is positive expectancy. So I don't really have any comments on this. I think this is an excellent trade setup. I don't think that there's much we can do. Now, obviously, if there's specific events happening on a day, that may be a time where we say, okay, we're going to skip this trade. We're going to skip it. So might be something to consider. You guys are great. We've got 20 people online. I'd love to see some more chat in here, and just let me know what stocks you want me to look at. We'll pull that up. We'll take a look at some trade ideas. I've got 6 likes, which is fantastic. Thank you very much. Do you guys have tell me what services you love to use? Like, if you're doing research, what's your top website that you're like looking at something and saying, okay, this is my go-to? Like, is it Bar Chart? Is it investing.com? Seeking Alpha? Christina's asking about Palantir. That's a great question. Let's jump into Palantir and we'll take a look at what is going on with that. Christina, you've got covered calls on Palantir, if I remember correctly, right? That's the I feel like we chatted about this a little while ago. The fair market value is like, it's laughable. I see this stuff and I laugh. Like, this is crazy. This is a quant rating. So if you were to trade, some sort of algorithmic trading, they're calculating the fair value at $61. The stock's trading at 132. That's 53% downside. I would say that the performance has been great. The value is sucky. The cash flow is great. Their net income is expected to grow. They've got a whole bunch of things like impressive gross profit margins. So they could easily continue this trend. If I wanted to play something like Palantir, I might look for something like this. This is a Yield Max Palantir Option Income Strategy ETF. And the reason I like a stock like this, or an ETF that's set up like this, is because I don't have to own the shares to sell covered calls against it. the price is a little bit cheaper too. It's $65 for share. So I can get into a covered call strategy by just purchasing a single share, 65.76. So for small accounts, this makes a lot of sense. I can just buy a share, and what this does, these pay out a dividend. So in December of so if we look at, sorry, here, the ex-dividend date. So in May, this stock, which, let's just go back price wise, 65 bucks. Okay, $65. The dividend in May was $7. So that is more than 10% in a single month. You can see here the dividend yield is currently 128%. The annualized payout is $84. So $84 on a $65 stock. This is paying out greater than 100% return right now. It's an ETF that they're designed to pay out dividends. That's what they're designed for. So if we're in a small position and I am looking at a stock like Palantir, and I'm saying, okay, I don't have the money to buy Palantir, you know, for $132. I want to sell covered calls against it because I know there's income there. The covered calls are going to cost me $13,000 right now to buy those stock and to sell a covered call against it. I may not have that much money. I could start a very small position in some of these high flying stocks for a very, very little amount of money. So something to consider if you're looking for strategies like the wheel. I think that these stocks like YieldMax option income strategy, they're pretty awesome. Like, zero time commitment. Just buy the shares, sit back and collect the dividend. And when the dividend gets paid out on a weekly basis, say you bought 100 shares of these, you got $6,500. Well, the income in May was $700 off of that, $7 per share for the month of May. So a $6,500 investment that pays somewhere between $400 and $700 a month, kind of crazy high. Simply Wall Street, interesting. I've played around with Simply Wall Street. I thank you for that, David. I appreciate that very much. I may have to revisit. I feel like Simply Wall Street, I used to use it years ago, and I kind of have graduated to other things, and maybe it needs a reassessment. Maybe I should reach out to them and see what they've got to offer. And thank you for that. And this is why I ask these things. I like to share kind of what's working, what's not. One of the things that I didn't love about seeking out or to Simply Wall Street was I couldn't figure out the analysts. Like, you'd read so many articles that were like pro and con on the same day, and you're like, okay, is there any correlation here? And I understand that these are independent writers, but I think that there was a lot of articles that were being written that people were playing like both sides of it. So they just kind of like had canned articles, and I know that happens on all platforms. You've got, like, you know, somebody's like, oh, it's going to the moon, and the other one, it's going to zero. And, you know, kind of constantly. But I remember Simply Wall Street being, you know, a young investor. Looking back a while ago, it's been a while since I looked at it and used it on a regular basis. And I found that it was a bit heavy in that kind of thing. And it was like, well, it became confusing. And I try not to read a huge amount of articles anyways. I very much am looking at pricing. Price action is where the money is. You know, people can think that a stock's going to go up and up and up and up, but if the valuation is wrong, then they're probably going to be incorrect. Christina says, yes, I have 5,540 shares on one account. Another has 156 shares and sold the 2150 covered call expiring 620 in the big account, and a 70 covered call expiring 815 in the small account. Yeah, well, congrats. I mean, those are huge positions. You've obviously done very well, Christina. The premium is big on those. The positions are large. So I can't really comment on how much without any more information. But when we look at the value of how much money there is in extrinsic value, even that 70 call expiring 815 is probably paying a decent amount because you've rolled it out so far. So when we look because there's a really good chance that it could go down that far. You know, I don't, for your sake, I don't want to see that happen. I mean, I would rather see you making some money. So we're looking at July. Let's go to August. We're August 15th, 70 covered call. So what I'm doing is looking at extrinsic value. So if I was to sell this position and then buy the 100 shares today, I'm not going to let me add that. Quick little technical glitch there. Okay. If I was to do that, you know, the cost right now is, come on, we can do this math, or we can wait. We'll see what happens. But basically, it's a debit of 132 and a credit of 63. So unless the stock tanks, I mean, you've got a 98% chance of making money on that trade, which is amazing. The question is it worth the money? You know, the $48 on a $6,891 investment. And I feel like these calls, sometimes when they go so far in the money, even though they have a high probability, they may not be worth holding on to. The amount of return, if I was only to make $48 divided by 68.91, which is the amount of risk that I have on, or the amount of risk or capital that I have tied up, I'm making 0.69% divided by the number of days. Well, this is 73 days out. So we times this by 365. I mean, this is going to be like a 5% return or something. Yeah, 3.4% return. So getting into that realm of being, it's not even worth it to hold these positions. And this is where it might be worthwhile to pay to roll some of these up. And I know that it's hard to pay, and I know that there's a lot of risk on there because that stock could go back to 62. But maybe it's worth just closing the position and saying, okay, well, that was a profitable trade. I made some money. I capped my potential, but I you know, made quite a bit of money. Or paying to roll up to have something that has a little more potential. Like if you're really bullish on it, how much does it cost to you know, pay? Let's just clear this off for a second. Say buy to close the 70 and then sell to open the 90. We're getting at 20 points. This is only costing about just over 18 points. So getting another $150 for this $1,850. This may increase the amount to a place where it's relative, you know, where we can make enough money to make it worthwhile to hold on to it. Let's just look at what the return is if we were to hold the 90 call. If we were to look at that profit profile, the max, it's still got a 91% probability of profit, but now it's going to make $228 on, and it is increasing the risk. Obviously, there's more risk as well. So let's again run that same math. Remember, we're comparing 3.4%. Let me get whatever that is. I clicked off of there by accident. So it is a bigger position. There's more capital in play, but the max return is going to be. I gotta reload this silly thing. While that's reloading, let me just pull that calculator up again. So the max return is going to be 90 minus whatever the debit's paid, so just over $300. So let's just call it like 310. That's calling it 308. 310 divided by 86.99, and we then divide that by the number of days, and the number of days were 73, and we times that by 365. And remember, my rolling options record keeper automatically calculates this out, but we're in a position now where that's making 17% a year as opposed to 3.4%. So there's a sweet spot for short puts and for covered calls, and it has everything to do with extrinsic value. Congratulations on holding Palantir for as long as you have. It's you know, with that amount of risk that it has on it, congrats on having such a big position on it. That's a nice win for you. Terry says, I use stock unlock, watch market call, and listen to Amber Canwar, but I only have a small account and paying for a service is unreal. Yeah. And stock unlock, watch market call, and listen to Amber Canwar. Thanks for those, Terry. I'm going to check all those out. I'm just making a note of those. So thank you. Appreciate. And I always like it when people give me things that I haven't looked at before. You know, I've been doing this a long time. I feel like I am a resource that people look at, and then it's nice for me to be able to connect with other people that are valuable resources to my viewers. Christina says, I have a couple shares of PLTY in my Roth, looking to buy some more soon. Yeah, I mean, they're the huge amounts of pay, like making 100% a year is crazy. And wow, your cost basis is $28. Well, congrats. I mean, that's amazing. You've done really well. I feel like I'm gonna get off the horn here. I've got a busy day ahead of me. I believe it or not, I have to go cut a hay field, and I got two acres on a family property that we're having nice warm weather here, and I'm gonna get out there, cut it so we can get it flipped and dried and baled in the next couple of days. So I am going to bid you adieu, and I'll see everybody in my chat room on Thursday. If you're already a paid member, then you can see me in my Thursday chat where we go over the portfolio and look at the positions, and I'll see everybody else next week. Thanks so much, everyone. Take care. Let's get rich together. Bye now.